Hello everybody, welcome back to Metals and Momentum. My name is Anthony, and in this video I'm going to show you some real world examples of how the housing market in Canada is collapsing. It is unbelievable. I wrote this article about how everybody in my neighborhood is getting evicted, and I was curious. I was looking at a couple of ratio charts, and ratio charts are great when you're trying to determine what to buy. Like, for example, if something is at like an all-time high on a ratio chart, it's going to tell you whether or not you should buy one asset or another. So I tend to use these ratio charts to determine what is undervalued and what is overvalued. We did this recently with the oil to gold trade the silver to oil trade that we just recently put on. I informed my Substack subscribers that I was actually moving some of my silver over into oil stocks. So we were doing that early in this year, and this trade played off very well. In this video, I want to focus on this real estate to gold ratio. So you can actually go into the article that I have linked below. It's going to take you to my Substack, Metals and Momentum. And then there is an article that I wrote on the 17th. I sent it out on the, I sent it out on the 16th, but it's part of the newsletter that comes out on a bi-weekly basis, which was the 17th. So go ahead, click this article. You can kind of read through it, but I want to skim through a couple of different points. Like, for example, if you want to view the real estate to gold ratio, I've linked to that chart right here, and I'm going to show you some really interesting things and how this ratio actually works and what it's actually signaling right now, because on this channel and how my whole investment kind of philosophy works is all based off of technical analysis. And I really like looking at a chart, and the charts will tell you when to buy, but the ratio charts, like the real estate to gold ratio, this will tell you what to buy. And I think this is super interesting. And I can tell you that I am getting a front row seat to this housing decline in Canada here. So this is a sign that was on a garage door that fell off the garage door, but this sign was also posted on the front door of a house in my neighborhood, a couple streets down. Now, what I also will tell you in the article is that there has been about six or so people on my street either evicted or removed from their home because either they're not paying or they've stopped paying the landlord. Now, this property here is one of those examples where a landlord had a tenant that just basically stopped paying. And if you click on the photo here, we can actually see what it says. So this is a notice, and it says, "This property has been abandoned. Entry is strictly prohibited. Possessions have been taken over by the owner. Trespassers will be prosecuted for any questions." And then it listed the owner's phone number on there, which is I thought was kind of strange, because I was talking this with another investor, and she was saying, like, what questions are you gonna ask? I don't the house is full of stuff. There's crap all over the lawn. This looks like about 2007 in Canada, but like if 2007 was happening in the US, like, we are totally seeing the same things play out. I can tell you, in my neighborhood, there are very well-off people. Like, for example, in this article, I mentioned that, there's a Lamborghini Huracan parked in the garage about 3 doors down from an abandoned home. This abandoned home right here. This is a fairly new neighborhood. It has just been built back in 2021, and there was obviously a panic to dive into homes during 2021, and a lot of people did take over their homes here. There's my whole street is essentially owned by real estate agents, and they are losing their shit. Like, they are totally freaking out. My real estate estate agent that owns this property. He told me straight up like that they're not making money on these properties whatsoever. 2 houses down from me, there's been a person evicted. They didn't pay for 6 months, and they're getting evicted. And then that landlord was asking my landlord if I had anybody in mind that might want to rent 2 doors down from me. Like, they are totally desperate for good tenants who are willing to pay, but the laws here in Canada are so lax. Like, I could have said, like, if I was somebody who didn't have morals, like, I could essentially not pay for 9 months, and they couldn't do anything to evict me. Now, the rules are tightening now, so that time frame is getting smaller and smaller for people from the moment you start getting, from the moment you stop paying your rent to the moment you get evicted. It's about 6 months right now, but the rules for landlords in Ontario have just been absolutely ridiculous. But this is a real world example of what is actually happening in my neighborhood. And I talk a little bit more about that in the article. And I was thinking to myself, like, what are the catalysts that are coming down the road for real estate? And I'll list out a few. And these are like legit sources. Like, for example, Royal LePage, CMHC. These are not like some fringe statistics. These are what the statistics are being put out by. Like, Royal LePage is one of the biggest like home sellers here in Canada. So like, these are legit sources here, and they say about 60% of mortgage renewals in 2025 and in 2026 will result in higher monthly payments of homeowners. Now, if you bought in 2020 and you are about to renew either in 2025 or 2026, you are experiencing a 9x increase in your interest rates. This source also says more than half of Canadian mortgage holders renewing this year expect payment increases despite interest rates declining. And that, like I said, because if you purchase that mortgage in 2021 or 2020, then we were essentially at 0. I think it was either 5 or 3%, and interest rates now are 9x higher than back in those low interest rate periods during like COVID. And 25% of the Canadian population purchased their home back in 2020 or 2021. The renewal wave is actually clustering around the spring into mid 2026. So if you purchased a home back then, you are about to renew in 2025 and 2026. We don't have 30-year mortgages like the US, and this is all coming due in 2026. So this is going to be an interesting time. What I'm noticing in my neighborhood right now is there is a constant flow of U-Haul trucks coming in, picking up the essentials, and then leaving. And then the non-essential items are just getting thrown on the front lawn, and the real estate agent or somebody, maybe it's the builder, if you've actually purchased the home, they're left to clean that crap up. Like, there's just so much shit all over people's front lawns, and it's because they've stopped paying, had to rent a U-Haul, took the essentials, and left the other crap on the front lawn. And it is absolutely nuts in my neighborhood. I moved here in October of 2024, and by spring of 2025, I watched bylaw agents come and remove my neighbors. That was the first one that I actually saw and like actually witnessed. Bylaw agents come, they left a notice on the door, and then a few days later, they came and actually removed my neighbors. It was a wild experience, but that is what's happening in a more somewhat affluent neighborhood. Like, this is not a crappy neighborhood. This is a brand new subdivision here in Ontario, and yeah, like I said, the neighbor has a Lamborghini. I walk by it with my dogs all the time, and I'm going like, whew, My goodness, that's that's a nice car. But yeah, there's a lot of very large homes around here that are selling for, at the peak were like 1.2 million. Right now they're coming down, and they're still asking around 850 for some of the homes in my neighborhood here. So the neighborhood is not like a crap neighborhood whatsoever, and these people are just getting slammed with renewals, and then packing up their shit and essentially leaving. So it is absolutely unbelievable. I'll write more about it in the article here. But what I want to go over right now is this real estate to gold ratio and really answer the question, is 2026 the time to buy? Now, I preface that by going over a couple stats that don't make it seem like 2026 is maybe the time to buy. I think we should watch the renewal rates play out. But if we use this real estate to gold ratio, this is really interesting. And I want to walk you through a situation where you would have profited handsomely if you followed this real estate to gold ratio. And I'll walk you through this time period. Now, this is an extreme example. Like, for example, I'm going to go through this 1970s kind of time period because it's a great example of how much you could actually profit during this period where you're watching this real estate gold to gold ratio really compress. Now I'm going to try and make the math a little bit easy for you so you can follow along here. So in 1970, it took about 1,000 ounces of gold to buy one average house in the United States, right? Now, by 1974, let's just take this this peak right here. I think I wrote in my notes here, let's call it like 230, just to make the math easy. So the real estate to gold ratio went from 1,000 down to, let's call it 230, just to make the math nice and simple. So back here, this was telling you that instead of buying real estate, you should actually buy the gold, right? Like, so because this peak is so high, it took 1,000 ounces of gold to buy one average home in the United States. And then by the time you hit 1974, you're roughly around 230 ounces of gold to buy the average home. So what's the math on that? Okay. So in 1971, 1,000 ounces of gold would have cost you $35 per ounce. By that time, at that period of time, gold was actually linked directly to the dollar. So it was redeemable. An ounce of gold was redeemable for $35. So 1,000 ounces of gold would actually cost you about $35,000, right? So by mid-1974, let's call it somewhere around this period, by mid-1974, gold was delinked from the dollar. So no longer redeemable in, the dollar was no longer redeemable in gold. It meant that gold can just free trade on its own. It's going to find some sort of price discovery. Obviously, we now know that that meant that gold was about to essentially skyrocket in dollar terms. So by mid-1974, gold was $155 per ounce. And that's why we see this compression in real estate. And we also saw interest rates rising at that time. So not only did home prices go down, but also gold prices went up. And that's why we see this dramatic, like, quick decline in this ratio, right? So we have home prices going down, gold prices going up. That means this ratio is going to go down. So by mid-1974, gold was at $155 per ounce. So what is that dollar value actually worth? So your initial 350,000, sorry, let me try this again. Your initial 35,000 ounces, $35,000 put into 1,000 ounces is actually worth $120,050. So by mid-1974, we could see this ratio start to compress. And you can look at this ratio and go, wow, we have seen a dramatic decrease in this ratio. Maybe I should convert 230 ounces over to buying a home. And I bet some people probably did that, right? So you initially started by buying 1,000 ounces of gold. You watched this ratio chart play out, and at about 230, let's call it just for simple math, you converted 230 ounces of gold over to a home. But you're still left with a lot of gold, right? Like that's two, so that's two, it's like a little, I guess that's a little less than 800 ounces of gold. And on top of that, you've experienced the price appreciation of those gold coins. So this is actually really crazy, and this is where this ratio chart starts to really make you think, right? So you now own an average home in 1974, which you purchased for 230 ounces of gold, but you're left with a lot of gold, right? So that gold is actually still worth $84,400. Now, let's look at this gold chart here for a second. And so this is the appreciation in the price of gold. So we see gold go from mid 70s, from $35 an ounce up to 182, let's call it. Let's go 180 or so dollars per ounce at the very peak. You could start to convert that gold into real estate, but gold actually had another run up. So if you held on to the slightly less than $800 ounces, you experienced another wave of movement in the price of gold. By 1980, the price of those ounces, or 1 ounce of gold, is 662 ounces. So I just doing some simple math here. So we started with 1,000 ounces. We're going to minus 230 ounces, so that way we can convert those ounces into buying a home. Let's see how many ounces we're actually left with. So this is 770 ounces of gold, right? Now, so we are looking at the price of gold. So by the time you hit 1980, let's call it 600 ounces, $600 per ounce. So we can do $600 per ounce times $770. And then what is the math on that? So your 770 ounces is now worth 462,000. So that is the power of these real estate to gold ratios. And what's really interesting is I'm going to move the time frame up a little bit further here. And then we can look at from 2008 onward, just so we can get a more clear view on what's actually going on today. So just before 2008, at about 2005, we can see that the ratio on this chart was 746 at the peak. Now, if you converted your gold, if you converted your dollars into gold because you saw this ratio that looked quite high during this time period, like there's a pretty solid peak right around this 2005 kind of level. And you could start to see in the United States that real estate was going crazy. People were starting to invest their life savings into multiple properties. The prices of homes were just skyrocketing, like 25% per year, if not more. You can start to think about converting some of your dollars into gold. And if you did that, you would get roughly about 746 ounces, somewhere near the top around here, right? By come 2012, you would only have to sell 153 ounces of gold to buy a piece of real estate in the United States. And you started with 746. So this is how the ratio works. But what I was also looking at is, let's just zoom in even a little bit further on this ratio chart, and we can see that during 2020, we were experiencing just like an insane real estate market here in Canada. And that's what I'm talking about right now. Here in Canada, it was just absolutely nuts. There was lines out the door. People couldn't even go and inspect a home because they would be worried about the property actually selling by the time the inspection was done. It was absolutely nuts. So if you take a look at these peaks here, back in 2019, you experienced you could have purchased 292 ounces roughly of gold, and then back in 2020, or I mean, if you held until like right now, you would only have to sell off 125 ounces of gold to purchase an average piece of real estate. This is measuring in United States. It's roughly about the same in terms of dollar amounts here in Canada as well. And in fact, actually, gold has performed better in the Canadian currency than in the United States currency. But we'll just kind of try and focus on the U.S. dollar and U.S. market right now. And what I was starting to see in this here, in this chart, is my technical analysis brain starts to look at this chart and starts to draw lines in my head. So we could take this low from 2011, and if you connected it all the way over here, and then there's an obvious, I would call this like a ceiling. Like for example, it's kind of hard to break through this general area right here, which is about $300 per ounce, or 300 ounces, sorry, of gold. So I'm looking at this chart, and this is where I'm going to go back to the article here, and I'm going to teach you a little lesson in technical analysis, and then we're going to apply this to that real estate to gold ratio, and it's going to show you something very, very interesting. So bear with me here. This is not as complex as it really seems, but I'll walk you through this here. So I created this chart here in the newsletter, and it's linked in the article down below. You can actually see this is a bullish, meaning going higher stock movement. So if the price of the asset goes up, reaches a ceiling, and then bounces back down, now we've created a floor, and a trader might essentially buy the floor, sell the ceiling, but if it breaks out, then you would actually want to buy the breakout, right? And that's how a stock going higher would actually normally behave. Now, this is super simple. It might trade around in a range for a little bit of time, then break out. But to keep things very straightforward, you have an upward sloping chart like this. We've reached a ceiling. You would normally bounce back lower, reach some sort of bottom. That's where you would draw that floor in, and then you would start to move upward, potentially breaking out. Simple breakdown of a bullish chart pattern, creating some consolidation. So we create this channel right here, and then a breakout tends to happen from there if momentum is pretty good. That's a bullish chart, right? But I want to show you what a bearish chart looks like. It's essentially the inverse of what we just went over. We can see the price of a stock or an asset is going down. We break through this point of resistance. Now that point of resistance becomes a ceiling. Eventually, you're going to get some sort of bounce. That's going to create a floor. And then you bounce up, tap the ceiling, and then continue the downward movement. And that's generally how a bearish chart pattern actually works, right? So you've moved lower, you've created the floor, you touch the ceiling, and a trader might think, I'm going to buy the floor once we start to bounce here, and the trader might pick up shares somewhere around like here, and then sell that ceiling right here, and then the movement would continue down lower. Now, knowing the two things that we just went over, what I started to do is apply this theory and price charting kind of pattern to the real estate to gold ratio. So like I said, my chart-minded mind starts to draw lines, and we can draw lines right here. So this is our floor, and this is our ceiling. So based off of the lesson that we just went over, what is likely going to happen here, right? What is likely going to happen? We see a chart. The real estate to gold ratio declining into a floor. Now, maybe we could consider buying the floor back in 2011. So you would convert your gold to homes back in 2011. Then if you did that, then you timed the market absolutely perfectly, because that was the bottom in real estate. You now own a lot of real estate and some gold, right? You start to realize, okay, we're struggling to break out of this point right here. I'm going to draw the line up to this point and see what happens. We start to bounce lower. We make another attempt at the ceiling. And then we start to bounce lower again. Okay, now we've tested this ceiling 1, 2, 3 times, and then experienced a drop lower. We would have, at this time, thought about maybe selling off your real estate for gold ounces. And you would have experienced this, and then a big move back upward. But I mean, if you're just following along and just not really any skin in the game here, what does the chart pattern actually tell you when it breaks right here, right? So let's hop over to the real estate to gold ratio and just look at how many ounces that is. So that's today is 125 ounces of gold to buy an average home. But if you use that chart pattern and chart lesson that we just went over, what is likely going to happen in the future? Well, a bearish chart, which is what we've determined is happening with the real estate to gold ratio, would break through the ceiling, or actually create the ceiling, create the floor, and we've tapped that ceiling, and now we've broken lower. So using technical analysis, we can actually see that the future might look similar to this, because we've broken through that floor. And I would be saying to myself, watch out below. Like, oh my goodness, this is really crazy stuff when you apply the charting pattern to the ratio. And it almost is like it's signaling, because we have this breakout down here, that in the future, real estate is going to continue its decline in price. Gold is going to continue its rise in price. This ratio chart is going to go somewhere maybe down here. And at some point in time, it's going to reverse and put in a floor. But it's not right now, because we're currently breaking below this floor that we've called that we've drawn. And it connects to that 2012 floor that we created there. So we know there's some sort of support right here. And in fact, if you hop over, you could see that we did actually a little bit, like, we struggled for a moment, right? We struggled for a moment to get through there, but eventually we broke. So either what's going to happen for this ratio to continue lower is real estate is going to have to decline, or if real estate doesn't decline, the other thing that could take this chart lower is gold would continue its ascent higher, which I think is a pretty likely thing to happen. But I also think, due to some of the catalysts that I'm going over in this article, like, for example, this, and also some of the stats that Royal LePage CMHC is putting out, this is signaling that in the future, real estate is likely to come down lower, and gold is likely to go down higher. And this real estate ratio is showing us that that is likely to happen due to that breakout down here. Now, this could reverse. Like, it's not like a guarantee, right? Like, it could reverse and start to float back up here. And in the article, I did put out a point where this would actually reverse. I'm pretty sure it was 139 ounces. 130. If we broke above 139, that would be a bullish signal for real estate. Watching this chart play out here, right? So 139 is the point where this floor would be broken, and then we break back into this channel here, and that would be a point where I'd be watching and thinking, maybe that move is over, and maybe we should think about converting the the gold that has appreciated so much over to real estate. But that is not happening right now. I'm just saying, like, if there was a signal to watch for and a number of ounces to watch for on this real estate to gold ratio, I would be thinking about that 139 level. So I'm going to leave the article for you to kind of go through. There's a lot of great information in here, and a lot of interesting points and statistics that you can go through. I'm going to link this in the description down below. If you want to get access to the paid version of my newsletter, it's $9 Canadian a month, so that's super cheap, especially if you're in using American dollars. Some of the benefits that you actually get: actionable trade alerts on a short-term swing trade kind of basis. That's kind of my bread and butter. That's what I'm thinking about the most in 2026, especially as the S&P 500 declines. I've just posted a video telling everybody that, you know, the S&P 500 just signaled a breakdown, and it's actually breaking down on the chart. You're going to want to watch that video if you're invested in the S&P 500, that is for sure. So you get actionable trade alerts. That's part of the paid part of my newsletter. And then you get access to a longer term portfolio and a watch list with more in-depth analysis on the charts. And I basically use a number of indicators to signal when to enter and exit some of my long-term holds that I might hold for maybe like a year or maybe even like half a year or something like that, or maybe even longer. It just depends on the trend and when those indicators signal that, you know, we should start to exit the position or start to enter that position and ride that wave upward. Right now, the S&P 500 is starting to decline. That's why I think it's going to be a great year for swing traders, and you might want to get access to those actionable trades that I'm actually taking with my own money. It's not investment advice or anything like that. I'm just going to tell you exactly what I'm doing with my money, and that is where I'm going to leave it. Thanks so much for watching. If you like this video, hit the like button for me. It really helps out the channel and get this video out to more viewers. Thank you so much for watching. My name's Anthony, and I'll see you in the next one.